with the Equity Management Academy. This segment is brought to you by the Equity Management Academy. I want to thank everybody for taking the time out to join us today. It is a great pleasure to have with us live today one of the real titans in the business, partners with billionaire Eric Sprott, Sprott Asset Management, and president of Sprott Asset Management USA, Mr. Rick Rule. Welcome to our live trading room, Rick.
Thank you, Pat.
What I would like to do is move right into the current news that are making headlines today. Basically, the eurozone crisis seems to be a bit stale in the news, and the market seems to shrug off the risk aspect of the sovereign bonds, especially Greece or Spain or any of the peripheral countries. What do you make if the world bond market vigilantes begin to pressure and demand a higher yield, lower prices on the sovereign bonds, or force world interest rates higher based on unsustainable record levels of debt?
Well, certainly if you put the word if in front of the question, it's easy to answer. Higher interest rates will divert more money into sovereign and corporate issuers and away from equities. The capitalized value of dividends in equity markets will fall, so reasonably one could expect interest rates to fall. And of course, the fallout for borrowers of all types, from sovereigns all the way through credit card purchasers, would be strained by increasing debt service. The interesting question is, how long can the big thinkers of the world, the Yellens and the Merkels and the Obamas and the Carneys and all of those types of people, continue with the easy money program and continue to depress interest rates? And how long will it be before private sector borrowers respond to market forces and, in fact, demand higher yields, given the increasing vulnerability that borrowers have to over-leverage balance sheets? Sorry for the long-winded answer, but I think it was a nuanced question.
No, I appreciate you giving us as much as you can, because I think everybody's concerned whether this situation is going to spill over to the U.S. According to the U.S. economic data recently, it seems to indicate that we have an uptick in the economy here. Will the eurozone deepening crisis eventually take a toll on the U.S. economy, or do you think that the U.S. economy can stand out and survive independently?
Well, I think that we have the ability internally, if we put our own house in order, to survive eurozone instability. I would also point out that we've had 3 years to prepare for a Greek default. And in the 3 years, the private sector has done a very good job of shirking the risk onto the back of taxpayers. The idea that there's going to be a lot of bank exposure in the eurozone to Greek debt ignores the traditional fascist response, where you privatize the profits and you shift the risk to the public sector. So I wouldn't expect a Greek default to have real ramifications in the private sector. Where it might have real ramifications would be in sentiment rather than reality. But the private sector banks have done a great job in making sure that the eurozone taxpayers bear the cost of a Greek default, at least initially.
Sounds like Cyprus all over again, doesn't it?
What do they say? History doesn't repeat, but it rhymes, and I suspect that's the case.
Hey, listen, Rick, are we headed for a major economic crisis worse than 2008, or is this just propaganda?
I'm not an economist, Patrick. I'm a credit analyst. From the point of view of a credit analyst, we are less well prepared to handle a crisis than we were in 2008.
Sure.
That much I can say for sure. If you look at the debt levels, at least in terms of government, the debt levels are higher than they were at 2008. But the other thing that's a bit worrying to me is our ability to add liquidity and generate economic activity by adding liquidity has been damaged simply because we've played that card so often. People have always made a mistake. At least I shouldn't say always, but they've always made a mistake in my lifetime by not understanding how durable, in particular, the U.S. economy and U.S. society is. But the truth is, we had one sort of past experience with this sort of guns and butter regime that we're going through now, and that was in the mid-'60s when I was a very young man. And it led to a period of economic and social instability in the 70s that, while we certainly survived it, was also certainly trying for the people who went through it. And I would encourage your viewers to organize their lives in a way that perhaps didn't predict collapse, but that emphasized prudence. The truth is, if we head into a set of circumstances that doesn't involve apocalyptic collapse, but does involve a circumstance like the circumstance that our society endured in the 1970s, being prepared is probably the best sort of strategy that one could employ.
How will this affect the price of precious metals, and in particular gold and silver?
Well, again, if past is prologue, certainly the decade of the 70s was very good for the price of precious metals and the price of gold and silver. I would urge your readers not to be among the people who pray for very high precious metals prices, because those very high precious metals prices are always a consequence of social catastrophe and collapse. There's nothing in the world that I would like to see less than the set of circumstances that would give me $6,000 or $7,000 gold. But I do believe that holding physical precious metals, not in anticipation of collapse, but simply in anticipation of the continuation of the diminishment of purchasing power in the U.S. dollar over time, is a prudent strategy. We've talked on your show before about the simple fact that on my way to work, I drive past a Motel 6. And when I was your age, a room at Motel 6 cost $6. That's why they called it Motel 6. Nowadays, the sign says Motel 6, $69. Now, Patrick, there can only be two explanations for this. One, the utility of a room at Motel 6 could have increased 11-fold over the last 30 years. Or the denominator, the U.S. dollar, could have deteriorated in terms of purchasing power by more than 90% over the last 30 years. And if you ignore the potential for economic collapse and simply think about the fact that the purchasing power of your dollar deteriorates at 3 or 4 or 5% compounded every year, then you'll understand why it's prudent to have a reasonable amount of your savings and investment matrix in physical gold and silver.
How has the gold market changed fundamentally in the last 3 or 4 years as we compare the U.S. prices in U.S. dollars against all other world currencies like the euro or the Japanese yen, for example?
I think there's probably three things we have to stress. One has been the increasing prominence of the gold and silver futures markets, that is the paper as opposed to the physical gold market. One would expect that the paper market will lead most of the time, taking its direction from the physical market, because certainly the paper market led the physical market higher in the 2009 to 2011 timeframe and then lower since. The second thing I think that one needs to take account of is that for the last 14 or 15 months, gold and silver have been in bull markets in every currency except the U.S. dollar. And in this case, this market is eerily similar to the market in 2000. I remember in 2000 having to write a commentary to my own client base, who were, by the way, predisposed to gold. And the title of that commentary was A Case for Gold. People were depressed enough in 2000 that I couldn't say the case for gold. I had to say a case for gold. And the sentiment that we're experiencing now, where gold's adherents are worn out, at the same time that gold is in a bull market in all currencies against the U.S. dollar, is quite similar to the circumstance that occurred in 2000. You will remember, or at least some of your older listeners and readers will remember, that in 2001, both gold and the U.S. dollar began to rise against other currencies. In 2002, when the dollar began to roll over, gold did very well. It's also instructive to remember that that 2000 bottom set off a rally that took gold from, I believe it was $252 an ounce all the way up to $1,900 an ounce by 2011. I'm not predicting, by the way, a seven-fold increase in the gold price. I'm just suggesting that the set of circumstances that surround us right now are quite similar to the set of circumstances that existed in 2000 in the first instance. And secondly, gold adherents need to know that the dominance of the paper market over the physical market is not necessarily bearish for gold. When the narrative turns bullish, the actions of the players in the paper market will be just as bullish as the actions of the player in the physical market.
Would you say we're at the bottom of the cycle then at this point?
I don't know the answer to that. What I do know is that gold and silver are cyclical, and that the narrative is very much emotional rather than mathematical in the near term. And I think the narrative is anti-gold right now simply because of the strength in the U.S. dollar. I personally believe that a lot of the strength in the U.S. dollar has to do not so much with the inherent strength in the U.S. economy, but rather in the relative weakness of all the major competitors. Doug Casey has famously said that the U.S. dollar resembles to him the prettiest mare in the slaughterhouse. I don't mean to be alarmist, but from my own point of view, while I appreciate the strength in the U.S. dollar, being American, I appreciate the fact that we can paint dreams on pieces of paper or bits in a computer and send them overseas and get things like Mercedes for them. I really like that, but I don't believe I'm entitled to it, and I wouldn't want to bet my financial future on it continuing.
Are we moving into a cashless society here?
I don't think so. I don't. I think that's a sort of an apocalyptic and alarmist set of circumstances. Many people hold the U.S. government in such low regard that they believe that they'll steal from you in every possible way. And they don't need to steal your cash. They don't need to steal your IRA. All they do is steal your savings by manipulating interest rates down and subsidizing spenders. The more alarmist outcomes that people point to, I tend to discredit.
Rick, why is the price of gold and silver in the U.S. kept artificially low to what appears to be major world physical demand? And how long do you think this will last?
I think that confidence is artificially high. I am not one of those who believes that there's an ongoing conspiracy to depress the gold and silver price. I think there is an ongoing effort to keep expectations and confidence unrealistically high. And I think this is really due to two or three facts. The first is that most people don't have a very good sense of economics. And people were scared to death in the 2008 financial crisis. The fact that the 2008 financial crisis appeared to have solved itself without the most apocalyptic fears of commentators and many people coming true, allows people to believe that the big thinkers in the world, the lever pullers, the Obamas, the Carneys, the Yellens, saved us, that we're in good hands. There is confidence in the financial system. The second thing is, and this has been proven again and again, people's expectations of the future are set by their experience in the immediate past. And if your experience in the immediate past has been pretty good, particularly given what you had been fearing, then your expectation of the future is pretty good too. In particular, because it's more comforting to believe that the big thinkers of the world have the world under control, and you don't need to take responsibility for your financial future. For myself, this explanation is hardly comforting. I look at other times when the bulk of the population has been wrong. An example would be George Soros' famous run on the British pound. You know, George Soros said that he became a billionaire by finding broadly held public precepts that were wrong and betting against them. And he was very lonely for 2 years against the pound, losing money every month until he was $1 billion right. If you fast forward to the middle part of the last decade, everybody believed that the only thing you could do with real estate in the United States was get rich. Take on as much leverage as you possibly could. There were a couple people who thought that lending people 120% of the value of their home when they had bad credit was probably not a good idea. And although those people were right, they were only right ultimately. They were wrong for 25 or 30 months until they were right, and then they were right by 40 or 50 billion dollars. I bring these facets of history up only by saying that the end of a bull market like the U.S. dollar bull market can end precipitously, and it's really a function of the diminution of confidence.
Rick, what's the future of gold and silver as a global currency, and will it regain its status as the oldest form of currency in the world, or simply become, as some pundits call it, a relic?
I think the truth is that it's somewhere in the middle. I don't believe in my lifetime, or even probably yours, that gold will replace the U.S. dollar as a hegemonistic medium of exchange. What I do believe is that it will lose the fight less badly. I read a statistic the other day, and I forget who it's from, that precious metals and precious metal securities occupy about 1/3 of 1% of savings and investment portfolios in the United States. At the top of the big bull market in 1980, my recollection is that precious metals and precious metal securities accounted for about 7% of private savings and investments. If precious metals and precious metal securities equaled 1% of private savings in the United States, that would suggest tripling in demand for gold and gold equities. That's leaving the rest of the world out of the equation. So I don't believe that gold will supplant the U.S. dollar or will supplant special drawing rights as a medium of exchange. What I do believe is that their market share relative to other instruments will increase.
What is the gold-silver ratio telling us at these record levels?
I don't think that the gold and silver ratio has any relevance. The fact that silver is 16 times more abundant than gold in the Earth's surface talks only about theoretical physical supply. It doesn't talk about the relative utility of each. History teaches us that silver is in effect gold on steroids. In bad markets, it underperforms gold. In good markets, it outperforms gold. It is, in a sense, trader's gold. One of the nice things about silver, from a bull's point of view, is that a lot of silver gets used in industrial capacities, which means it gets used up. We jokingly say it goes to silver heaven. Another nice thing about silver, I think, from a speculator's point of view, is that it is cheaper per unit to acquire, which means that if we begin to see a precious metals bull market with increasing access to precious metals by people in frontier and emerging markets, poor people will have more access to silver as part of their savings matrix than gold. And one would expect, given the historic volatility of silver and the access of more and more poor people to utilizing silver as a medium of exchange, that silver would outperform gold in a precious metals bull market.
Anything else you would like to add, Rick?
Well, I guess one thing I'd like to add, given that you gave me such carte blanche, is for those people who are viewers of yours who are holders of the Central Gold Trust, remember that Sprott is tendering for those units. The existing management team obviously doesn't support us, but they've had 15 years to eliminate their discount to the market, while we have never had a discount. And we would urge those people who are U.S. citizens, who are holders of gold and silver, to do the simple arithmetic and make the obvious choice.
How can our clients get in contact with you directly?
We would be delighted. In fact, I myself would be delighted to talk to your listeners and viewers. They can contact me by calling 800-477-7853, or they can email me, rrule, that's R-R-U-L-E, at sprottglobal.com, or they can go to our website, www.sprottglobal.com.
Rick Rule, President of Sprott Asset Management USA. Once again, it's been a pleasure to speak with you again and have your wisdom and insight. And until next time, my friend, You take care and be well.